What I'm about to do here is explain to you what I call my bulletproof pre-approval. So many loan officers overcomplicate the process of helping a client understand what type of price point they should be in when it comes to determining how much home they're pre-approved for. Now, more so than not, and not every time, but more so than not, you will always realize or find that the banks are likely going to pre-approve most people for more home than they can actually qualify for. So there's really two things that your clients are always thinking about primarily. One is payment, and two is their cash amount. What's this gonna cost me month to month? And how much money do I need to spend in order to buy this house? Well, if we start with those two answers and reverse engineer that out into the market, we're going to be able to quickly help them understand a price point range that they're in. We're going to remove any type of concern that they have for going up or down in price point. We're going to eliminate the concern they may have for the price point that they're trying to negotiate with the seller. Maybe they're fighting over 10 to 20,000. And we're also going to broaden their buying power to make our real estate agent lives easier. So by doing this, it simplifies the pre-approval process. We never talk about interest rate. We don't talk about interest rate until we get locked into a contract, and then we talk about options. Today is specifically designed to help you understand a more efficient way to pre-approve your clients so that they go out and make quicker decisions. The reason I came to this knowledge, I remember when Apple made a transition to accepting mobile pay. And I remember being in an Apple store where we had to wait in line to get to the register. And there was a day where I was waiting there with, I'm not kidding, maybe a phone case. And I was contemplating whether getting out of line or not, but I didn't need to be anywhere. There was a guy in front of me with probably $3,000 worth of equipment standing there holding it, waiting in line so long to buy this equipment that he just put it on the floor and walked out of there. And I thought to myself, God, that guy was really impatient. When I saw Apple change the way that people can pay for products and they check you out right there with the sales associate, you never wait in line anymore, I had this epiphany that I need to make this process just as simple for my home buyers as Apple makes it for you to spend thousands of dollars on the spot. We want to make sure that we can make a quick decision and get people into that process before they have too much time to overthink it. And the last thing you want to teach your client to do is to use a mortgage calculator or a mortgage app, which requires them to put an interest rate into that app to calculate the payment, because what you're doing is you're teaching your client to go look at interest rates. And we don't need to do that. So, as of today, in this marketplace, rates are around 7.5%. If somebody says, Anthony, what are your rates? I say they're between 7.5% and 6.5%. Or I might say 7.75% down to 6.75%. Once we lock your house, we'll spend time going out and finding you the very best interest rates. And when I go shop in the market, I eliminate risky mortgage products, I eliminate costly mortgage products, and I'll come back to you with some of the best options. I'll present them to you and you make a decision. But until you're contracted, we don't want to get overly focused on interest rates because we can't control the market. But here's what we want to do. We want to get focused on the cost of money. And we're going to go back to that in a minute. So the first thing I ask my client is, what are you currently doing right now? Do you own or rent? I'm going to use a renter in this situation. I say, well, how much do you pay in rent right now? Maybe there's a boyfriend or girlfriend, or they're splitting the cost on rent. Doesn't really matter. For this purpose, I'm finding out, what do they currently pay now? So the first question I ask is, what are you paying now? Let's say they're paying $3,000. They say, great. When you transition into owning a home, do you want to pay the same, less, or more? I end with more because the likelihood that they're going to be willing to pay more for a house and own it is pretty high. But 9 times out of 10, if I say, do you want to pay more, the same, or less, every single time they say, well, I'd like to pay less. So you want to say, would you like to pay less the same, or more. In this case, they want to say more. So then the next question I ask, what's your monthly payment goal? And they might say, well, considering the fact that we're going to own this house, we're willing to go up to $3,500. I say, perfect. Now, if you find the absolute perfect house, it hits all the check marks, and you see yourself living in that home for much longer, how high are you willing to go after that? And they might say, you know what? Our max comfort payment is $4,900. Now, that doesn't really seem like a huge difference to own a house, but when we allocate what that means for more mortgage, it really expands their buying power. So once I get to there, then I say, now I need to know, what's your total capital commitment? How much money can you depart with in order to buy this house? This is going to include your down payment and your closing costs. And they might say, you know what, Anthony? Our cash on hand, we've got $80,000. Great. Those are the only two things I need to help my client determine what type of house they're going to be in. Now I ask them what city and town they're looking in. They might say, I'm looking in Scottsdale, Arizona. Or they might say Chicago, Illinois. And then I'll say, what rough price points have you been looking at? Well, we've been looking roughly in the 500s. Awesome. What are you seeing for property taxes? About $5,000 a year. Perfect. I know that the property taxes are about a 1% ratio in this hypothetical scenario. So first thing I do is I write down their taxes, and I just divide by 12. And then I also calculate insurance. So I always use my calculator because I want to check my mental math. But if I take $5,000 and divide by 12, that's $416 a month. So for the purpose of this, I'm going to write $450 down as an average per month for property taxes. Then I'm going to go ahead and tell them, hey, we're going to add about $150 on top for homeowners insurance, property casualty, theft, damage. So I know that my fixed costs, and I'm telling the client this, my fixed costs are $600 per month. So all I need to do now is back this out of that number. And I know exactly how much I have left over for principal and interest. So if I take a $3,500 total housing payment, I subtract $600 out, their payment goal is $2,900, but they're willing to go up to $4,900. If I take that same $4,900 and I back out $600 for taxes and insurance, now we know the taxes are going to be higher here, but we don't necessarily need to go into that on a pre-approval call. So then I back that out. So if I take $4,900 and I back out $600 a month, I've got $4,300 left over for their max payment. Now here's where I simplify things for my homeowners. I tell them what the average cost of money is, and I base it on $100,000. The average cost of money right now for a $100,000 mortgage is $700 a month. So if I just take $100,000, at a 7.5% interest rate amortized over 30 years, I get a payment of $699. So I round that up to $700. Now, for every $100,000 that we have in a mortgage, we know that we're paying $700 per month. All I need to do is divide $700 into that $2,900, and I'm going to know how much money these guys can carry on a mortgage payment. So I take $2,900, I divide by $700, and that fits in 4.143%, which is the equivalent of a $415,000 mortgage, roughly. Now watch, if I put $415,000 into my calculator at a 7.5% over 30 years and calculate for my payment, it's $2,901, $2,901. I teach my client this aspect ratio. And I say for every $100,000 that you borrow, it's $700 a month. That's the exact same math as $70 per $10,000. So I tell my client, if you get in a situation where you're negotiating back and forth with the seller over $10,000, are you going to give up a piece of real estate for $70 a month? And the client says no. I go, all right, what about $20,000? Are you gonna walk away from your dream home for $140 a month? They say no. I say, the price that you're gonna pay within that $10,000 to $20,000 to $30,000 isn't gonna have a drastic effect on your payment. So if you love it, you're better off going for it. As well, if you decide to spend an extra $10,000 on that property, it's not gonna bring your payment down, because if you spend 10 grand, you're saving $70 a month. So we go back. We know that at their payment goal, they're gonna be able to mortgage $415,000. Now I've got $80,000 to deal with. I might take $15,000 out of that for closing costs. Let's just take 10 out of there to be safe. So if I take $80,000 and subtract 10, I've got $70,000 for my down payment. And if I add that on top of my $415,000, that becomes about a $485,000 house. So $415,000 loan. Then I've got $70,000 down because I need to park $10,000 for closing costs. In this scenario, they're at $485,000. So Anthony, what am I pre-approved for? And I'll say this to the client. You asked me what you're pre-approved for. Based on your payment goal, spending your full $80,000, you're not going to want to go much higher than $485,000. However, you told me that you were willing to go up to $4,900. That's a $1,400 difference. You can afford an extra $1,400 a month. How many times does $700 fit into $1,400? Twice. Let's check the math though. $1,400 divided by 700 equals 2. So we can fit this equation twice on top of this price point and still keep their payment in check. So ultimately what that means is at $3,500, they're here, and at $4,900, they can add another $200,000 on top, and now they're at a $685,000 property, and they're not concerned about their payment. So what this does is it quickly gives my buyers a very broad price point range, so that when they go look at homes between $485,000 and $685,000, they're not going to be worried about their payment, because I've structured this based on their payment. And that's how quickly I can get my clients on path to going out and focusing on keeping themselves in this price point, because this is all they care about, and we're never going to run out of cash. This is how quickly my clients will now go out and make a decision. And because I talked about only saving $700 a month, or the money costing them $700 per 100,000, they would have to put an extra $100,000 down to get $700 savings here. And they're not going to want to put that much cash down. I didn't talk about rates. I didn't talk about income. I didn't talk about assets. I didn't ask them where this money's coming from. I'm purposely doing this as fast as I can to get to these numbers so that they can go out and figure these things out on their own. However, once I'm done with this, they say, what's the next step? I say, you need to do an online application. I need to make sure that your job and your income and your assets can cover these payments and this debt. So apply online, and then I'll take a look at that, and I'll make sure that everything we talked about today can be done. I'm not going to waste 2 more minutes on the phone with that client unless their credit's pulled in my system. Why would I? What's the point? I need them to make a commitment to me. I need them going into my system, pulling their credit, so that I can actually look at their real file and just see if this stuff applies. Now, I might get in there and I might realize, damn, they're never going to get this high. They're only going to get to, let's say, $4,200 based on their income and their debt to income ratio. So they need to come down $700. So what do? If it's $700 per 100,000, I knock that down, and I simply say, relative to your goals, you were at $685,000. However, relative to your income, you're going to be capped at $585. Done. Now they know exactly what price point they need to be in. And when I send a pre-approval letter to the client and the agent, I might send it at $485, but I might call the real estate agent and say, hey, they're qualified up to $585,000 based on their comfort payments and their income. So why don't you go show them a couple things at that price point, because we need our clients making the decision to buy real estate based on which property is going to make them more money in the shorter amount of time. And I talk to my clients about this. I say, look, you might buy a $485,000 property. Maybe you're going to make 3% appreciation per year, which is less than 15 grand. But maybe you can get a quieter street, a better neighborhood, a better zip code, a better school district by paying a little bit more. Maybe that house has smaller square footage, but this is a much better investment relative to the city, town, zip code. Maybe you're going to make 5% appreciation over here. Well, even though the payment's only $700 difference per month, which is a little over, what is that, $8,200 a year, they might be able to make $20 to $30 extra $1,000 on their real estate. And now they don't care about the rate. And you want them focusing on what they care about and the things that are going to help them make a decision. Because if we train our clients to focus on interest rate, then all they're going to do is shop you for the interest rate. But if we get our clients to focus on the things that really matter to them, which is payment and cash, and we fit that into a model that gets them pre-approved for dollar amounts based on those payments, your job's done. Then they get contracted, then you go to work on the rate. Now here's how you deal with the client that's shopping you. Typically, you know when that client's shopping you. You know exactly when you're in a position because they're gonna say, hey, checking in, what's your best interest rate today? And you're gonna go, we haven't talked about rates at all. Why is this guy asking me what my rates are? So maybe I'll say again, hey, we're between 7.5% and 6.5%, but we need you to contract in order to fully understand where the rates are. And guess what they might say? Oh, I'm contracted. I'm trying to figure out where your rates are. Then this is what I say. I know you're shopping me. I can tell that you're shopping me. I actually wouldn't have as much respect for you if you weren't going to the market to make sure I was bringing you the best deal. But here's what I want you to do. I want you to go find the best deal that you can get, bring it to me, I'll match it or beat it. We love working with each other. I educated you, I made you feel comfortable. Go find the best deal you can, bring it back to me, and I'll beat it. I never get myself in a sales situation. I'll let him or her go do all the work they want for days and days and days. Bring me back the deal, and I'll always beat it. And if I can't, then I'll say, damn, that's a good deal. I actually can't beat that. If I were you, I would take it. But why don't I go ahead and lock your interest rate anyway and start working on your loan? That deal might be too good to be true. And if it falls through, I'll be here to take care of you. Or sometimes they bring you a bank loan estimate, or sometimes they bring you a loan estimate, or whatever that competitor is that you just don't like dealing with. Then you could say to them, hey, their close ratio is really low on their transactions. I would love to match that product, but we just know they don't have a really effective rate on closing people and getting them into their homes on time. So unfortunately, I can't match that deal, but I don't know if it's worth the risk. That's an easy way to deal with that situation. Now, let me show you one more thing that I think is going to be helpful. There's been many times where I've said to people, what's your payment goal? $6,000 a month. Maybe they're living life, they're living large. I go, that's fantastic. How much cash do you have? I got $20,000 to put down for down payment and closing costs. What's that tell you right now? Two things. One, they don't have enough cash, so maybe they shouldn't be looking at homes. Plus, whatever mortgage payment this correlates to, even with 3% down, they're not going to have enough money to cover closing costs and get themselves in that deal. So right out the gate, you know what type of problem you're going to have. You can say to them, look, dude, based on that payment, man, you're going to be able to get into a $600,000 or $700,000 property. But without 5% down in closing costs, you're going to really have to bump this cash up. Do you have another place to get another 30 grand? Can you get another 40 grand? Can you get another 50 grand? Because without more cash, I can't get you pre-approved. Relative to this number right now, with 5% down closing costs, you might be around a $200,000 property, which is going to be way less. Or you might deal with the opposite. I've seen this before. I want to be at $1,200 a month, and I have $200,000 to put down. I'm looking at a $700,000 property. Okay. Well, if I take $700,000 and I put 200,000 down, I know that I need to borrow 500,000. How many times does 100,000 fit into 500,000? 5 times. So all I have to do pretty quickly is take 5 times 700, and I know that that guy's going to have a $3,500 mortgage payment before he even gets out and starts working. So I can quickly say to him, sounds great, you have more than enough cash to put down on a house. However, if you want to keep your payment at $1,200 a month, that's less than $700 twice. That would be $1,400. So you're going to have to keep your mortgage under $200,000. You're probably looking at about $370,000. So if you're going to buy a $700,000 property, you better get ready to bump that up to $3,500. If I do that within the first 5 minutes of my phone call, that guy's listening to me and he's changing his expectations. If you don't get to that right away, you're going to take him through the process. You're going to tell him you're pre-approved for a $700,000 property because he's got a good down payment. Then he's going to contract. Then you're going to shop rates. And then you're going to show him a $3,500 payment. He's going to go, well, that's way too high. And then you're going to be like, what is this guy, confused? How does he not realize he's going to have a higher payment? That's not his fault. That's your fault. So when you figure out the most important things of your client's goals, which is how much is this going to cost me month to month? And how much cash do I need to put down? When you get those goals and reverse engineer them, you will get to success way quicker. Your buyers will buy way faster. And when you talk about the cost of money, $700 per 100,000, $70 per 10,000, they can make quick decisions. And guess what? It's simple math. When rates change, just update that ratio. If rates go to 4.5%, put $100,000 in your mortgage calculator. At 4.5% over 30 years, it's $506 a month. So call it $525 or $550. Round to an easy number and round up. So when they find a house and buy the house, those numbers get cheaper. That's how you educate your clients on how much a mortgage payment is, not by the interest rate. Save yourself the hassle. Don't get into a sales competition about interest rate. Focus on the payment. Get them a broad buying power so that their payment never goes out of check. And don't waste your time. Make sure their expectations are right. Make sure relative to the cash they have in the house they're buying, they don't expect to walk out of there with a $1,200 payment on a $500,000 mortgage.